So last time we were doing the income statement. So this time let's look at an actual company and see how we can look at the annual report and then understand. Okay, so we have Lal Path Labs here. Uh, so we'll go to the Lal Path Labs website. And you can see over here in any website, we have the investors section. So we'll come to the investors section. And you can see you have a lot of corporate presentation, corporate governance and all of that, but we will basically go to the financials. And in the financials, we are going to look at the annual report. Okay, so the annual report has opened. We'll also download another copy. So we come here to contents. And we see here we have corporate overview, all sorts of messages, financial highlights and all. And then we have some statutory reports, some management discussion analysis, business responsibility and so on. And then we have the financial statements. So today, since we are going to be looking at the financial statements, we will focus on the on this section. And over here, we will look at the profit and loss statement. So we are looking at standalone financial statement, where we are looking at the profit and loss statement, right? So we have to go to 171. So we are in 169. We come here and we are here in 171. Where we see this is the standalone statement of profit and loss. So over here, we start with this. We see that the revenue from operations, right? Start with this revenue from operations. We see it is 19,667 million rupees. And then there is some other income. And then we have the total income. And then we have all the different types of expenses, cost of materials, employee benefits expense, finance cost, depreciation, some fees, etc. that they pay, which is specific to their business. We usually don't see this in a standard income statement. Some other expenses, and then we see this is their total expense. And then we see this is their profit before tax, and then they have paid some tax, and then they have total tax expense. And then we see this is their profit for the year. And then they have some other sort of income, etc., losses, etc., whatnot. And then they have total comprehensive income for this particular year. So this is the standard structure that we have in any sort of an income statement. We start with the revenue and then we do the expenses, we do depreciation and all, we do taxation, and then we finally get the profit, right? So now we see over here, we have the year ended 2023, the previous financial year. So this was 2024, and then we have 2023 over here. And we see, okay, what is the total income? This is 18,156, and this is 20,000. And similarly, we can see what is the profit this year. It has gone up. So one of the things that is typically done in any annual when we look at any P&L statement is we do a comparison in terms of what is the growth. So if we look at the revenue, right? The revenue has grown by approximately, let me by approximately 11.63%, right? That is the growth we have. Similarly, if we look at the profitability has grown by 32%. So this is the profit before tax. This is the kind of growth that the company has had before tax. And then the final total comprehensive profit right at the bottom over here that we see. This is basically It's approximately 30%, right? So revenues have grown by about 10-11%, but profitability has grown by approximately 30%. That is what we see over here. So why would that happen? That would happen because expenses are not growing fast. The company is getting more revenue, but expense wise, it is not spending as much money. And therefore, its profitability will logically be higher. So let's calculate the expenses and see how much it has gone up by. So profitability has, so revenue has gone up by about 11%, but expenses has only gone up by 6%, right? And because expenses have gone up by 6% while revenue has gone up by 11%, finally, as far as the income is concerned, this has gone up proportionately much higher by about 30%, right? This is the first thing that we notice. So typically, when we look at any company's income statement, one of the key things that we have to look at is there any revenue growth? Is there any growth? What is the kind of growth in the profitability? Revenue growth and then profit growth. This is what we have to look at. And ideally for us, the main thing that determines share price is the growth in the profitability. And since Lal Pathlab has shown more than 30%, so this is showing a very positive trend in terms of the profit growth. So let's go to screener and so typically we take any company, right? One of the key things that that I always look at is what is the kind of growth that the company has been showing. What is the sales growth and then what is the profit growth that the company has been showing over the last few years. And typically we need companies that show very good sales growth and very good profit growth. That is one of the key indicators for showing companies that are doing well. So now let's look at some companies. Let's just take two examples. Let's take, for example, one is this. This has share price for some time. And then we'll look at another company that is not doing so well. So let's look at, for example, this company. This has 5% sales growth and 20% profit growth. Whereas Safari Industries, the other company we have picked up, Safari Industries does makes suitcases and so on. So Safari Industries has 67% sales growth and some 119% profit growth on average. This is not total in 3 years. This is per year. So per year, it has shown this much 67% sales growth and this has shown this much of profit growth. So when we look at a share like this, which is showing high sales growth and high profit growth, we see that this share price, which was about 85%, right? We are only looking at 3 years. So let's look at 3-year trend. So between 2021, we are looking at the 3-year trend from 2021. This company, which was at some 270 something rupees, has now come to, in 2024, it's gone up by almost 8 times. And why is that the case? That's because one of the key reasons, there are several reasons, but one of the key reasons is there is very good sales growth and there is very good profit growth. The company is earning a lot of money. So we look at the profit over here. This was some 22, is it crore? Yeah. So this is some 22 crore in 2022 and it has gone to some 176 crore. So it's growing very fast. Whereas let's look at this company. This is a chemical company. Alkylamines is a chemical company. And we see over here profit variance was actually minus 20%. So profits have gone down over the period of last 3 years. Sales is kind of growing very slowly. So when we look at this company, what do we see? This company was in, say, in 2021, it was at some 3,500, 3,700, and now it is at some 2,200, right? So the share price has basically been coming down. And let's look over here and we see that, okay, the profit, which was 295 crore, I think, yeah, it's in crore, 295 crore in 2021 is now some 149 crore in March 2024. And therefore, in the same corresponding way, the shares have actually come down. The share price has actually come down. So looking at the sales growth and looking at the profit growth is one of the key important factors that we look at. And you can pick up any set of stocks and see most of the time you look at the 5-year or 10-year sales growth and profit growth, and you can look at the stock price and you will see that any company which has very good sales growth and very good profit growth over 5 years or 10 years, you will typically see that its stock price has come up. So we can take a lot of different companies and see. So if you look at this company, Titan has shown 17% sales growth over per year in the last 10 years, 17% per year in profit, 21% in sales per year in 5 years, 20% per year in profit in the last 5 years. So now let's just look at its share price, right? You see, over the last 10 years, the share price has grown very significantly. This price, which was at about 395, 398 rupees, has now come to some 3,600 something. So by 8-9 times, that's how much it has grown. And let's for example look at let's just try to look at an example, right? So sales growth in 5 years. Let's look at a longer period. Sales growth in 7 years is greater than say 15%. And so you can create screens like this. You can create screens like this and see, okay, which company is doing well. So let's say more than 10% and more than 20%, right? Let's just run this query. So there are many different parameters that we will see, but one of the key things that we will see is we'll also look at market cap. We want slightly larger companies. We don't want small companies. Market capitalization is greater than 5,000. Let's just try this. Okay, so we have some good well-known companies here. We would have all heard of Nestle India. So we'll start with Nestle India. And then whenever we come here and then we see the price over the last 10 years, you can again see same thing. Share price was some 580 10 years ago. And now it is at some 2,700, 2,600 and so on, right? We can take a lot of good companies which have been there for a long time. Tata Elxsi, for example, this is a well-known Tata company. And you see share price, this was some 300 rupees and now it is some 8,000 rupees. You can take, we had Tata, let's take CDSL. All our shares are stored in CDSL, for example. And then we look at the last 10 years. So here you can see sales growth is 25% in 10 years and 33% in 5 years. Profit growth is 29% in 10 years, 30% in 5 years, right? This is one of the key parameters we'll use. There'll be several other things, but this is just one of the things. And we see here the share price in 2017. So it's not 10 years, some 7 odd years. It's 130 and now it's gone to almost 1,400. So it's gone by 10x. So we can go here like this into screener. We can go to screens here and then create new screens. And then you just type your parameters here. Sales growth, it gives you up to 7 years. And then just type your parameters here and profit growth 7 years is greater than, let's say 20. Just type your parameters here and then it will give you a short list of companies. And then you can search. Market capitalization means companies which are large. We'll talk about market capitalization later. We are just looking at companies that are reasonably large and well known, because small companies there may be fraudulent small companies, right? And then we'll get a list like this. So let's look at, for example, Tanla Platforms, Angel One. These are all known companies. So we look at this price over here, and then you can see it's been a low price. The sales has gone up and now the share price has also gone up. So if we just look at this, this was some 14 rupees and now it is some 800 rupees. We look at this stock. This doesn't have much of a history, just 4 years. Angel One, it's a stockbroker like Zerodha. So it was at 274 rupees. Now it is at 10 times that almost within just 4 years, right? So wherever we see that there is high sales growth over here, you can see we don't have 10-year number, but 5-year sales growth is high. And then profit growth, compounded profit growth is high. Wherever we see that compounded sales growth and compounded profit growth over a period of time is high, we will see that the stock price has typically gone up, right? And one of the key things that we need to look at when investing in a stock is, okay, over the next 5 years, over the next 10 years, do I think that this company has a lot of growth for its sales or a lot of growth in its profit? If yes, then that is one of the key things we will look at, and that is one of the key parameters basis which we will decide to buy a stock. How will we know whether the sales will go up or whether the profit will go up? We'll talk about that specifically during another discussion. But see, some of the key things that we look at is what are dying industries versus what are growing industries, right? So if we look at some petroleum or petrochemicals, etc., as an energy source, that is kind of on the decline. Slowly, there is more of green energy coming up. And slowly we see that in the world, we used to have a normal petrol car, diesel car, but now we are having electric cars that are an upcoming concept. Right. And if we look at the situation maybe 15 or 20 years later, we will find that there are a lot more electric cars as compared to today. And we'll find that petrol cars will definitely not grow. Most likely it will shrink, petrol or diesel cars. So that way, using our common sense and by understanding the market, by understanding sectors, and we'll talk about that in another discussion, we will be able to predict saying, okay, over here in the next 5 years, there will be good growth opportunities. And therefore, I think this stock can grow and so on and so forth. Right. So this we've just discussed this from an investing perspective, but now let's understand this income statement a little better. So in Lal Pathlabs, we see there is some section called notes, right? And we see revenue from operation notes 27, other income notes 28, cost of material notes 29, and so on and so forth. So let's actually look at, let's open this again and let's actually look at notes 27. So we'll go maybe to around 175 or 180, it should be there. Okay, we have notes, right? And then we have to go to note 27, if I remember. Yeah, 27. So we see here, notes 27 is revenue from operations. It says, what is the sale of services? So based on the sale of services and then some other operating revenue, right? It has some very small number. And then it will give you, okay, some more details. The company generates its revenue from contracts with customers for the services. So maybe it does some contracts with the local labs or looks like something like that. It is mainly engaged in the business of running laboratories for carrying out pathological investigations. So all our blood tests and so on, all of that is being done by this company. Then we see other income is 28. So it has $600 million million rupees of other income, right? So what is this? So we go to 28. We'll leave all this. These are some more detailed financial things. We'll leave all that. So now we see other income. Other income, it has bank deposits. So there is some bank deposit related interest. It has got some income tax refund, right? It has got some income from a subsidiary company. Then there is some rental income. So it has some property which it has given out for rent. So it has some rental income. And then there is some investments. So for which it has gained some value and so on and so forth. So this is not the core business. This is definitely not the core business, but we get an idea saying, okay, this 600 million rupees, what are the kind of other income we have got? Now we have this cost of material consumed, 29. So, okay, they are comparing it to the inventory. So typically, let's understand this in this way. So let's say I am manufacturing table and chairs. Okay, I'm manufacturing wooden table and chairs. At beginning of the year, I have some 100 kg of inventory, right? And then at the end of the year, I have some 50 kg of inventory. I have 50 kg of inventory, correct? So I have consumed what? There is 100 kg at the beginning of the year and then 50 kg at the end of the year. So this consumption from inventory. Consumption from inventory is Inventory is nothing but the stock of items of raw material or other material that they will keep, right? 50 kg. So at the beginning of the year, I have 100 kg of wood for manufacture of table and chairs. Okay. At the end of the year, I have 50. So this is basically equal to this minus this minus this. We'll leave the kg. Right. But in addition to that, I have also purchased. So purchase of wood. Wood in kg is, let's say I have purchased another 500 kgs of wood to manufacture table and chair. So I have consumed this amount for my purchase and I've consumed from my purchase and I've consumed this amount. So this is basically what I have consumed in my raw material throughout the year. So total wood consumed here is nothing but the sum of this. So they are showing the same thing here that, okay, this was the inventory and then we purchased so much. This was the inventories at the end of the year. And then therefore this is the total rupee million. And they're showing all this actually in rupees, right? We are doing this in kg. So they might have say 10 or 20 or 50 or 100 different materials. For each of the material, like, wood and then, I don't know, nails, other fitments, glue, all that. We may have all sorts of inventory. They've just converted everything from the kg and everything to the rupee, and they've just shown that, right? Next is they're talking about employee benefit expense. So what is the cost that they have spent on employees, their salaries and other things? So we see this is given in number 30. So once we go to 30, we see here there is salaries, which is approximately 3,177 rupee million. And then some share base. So there is some share based reward that employees are getting. Then there is some contribution to the provident fund and so on, some gratuity expense, certain staff related welfare expense and so on. And therefore, this comes to some 3,635, which is what they have shown over here. Right. Then we come to financing cost. Finance cost is usually nothing but the loan and interest to the loan and all of that. Right. So finance costs, we have some interest on lease, we have interest on some loan, there are some other interests and so on. So this is basically the cost that it has, they have on financing. Then we have depreciation. So this is there in 32. So here there are more details on the financing cost, what kind of borrowings, but this is all more from an accountant's perspective. This is a lot of detail. We need not go into so much detail. We can understand what these terms are if we have time, but this just gives us a, but since we are just getting into it, we understand the main things. That is enough for now. Then they have looked at depreciation, right? So depreciation of property, plant and equipment. We've dealt with what is depreciation last time. That let's say I buy some equipment and that equipment has a lifetime of 10 years. Then every year I will deduct a certain value uh, from that equipment, and that is the depreciation. So this is the depreciation amount. And then they have some other depreciation. And then there is something called amortization. So amortization is, let's say, for example, Lal Pathlab buys a smaller laboratory, which is very famous in one particular city. So let's say there is a laboratory, ABC lab, which is very famous in the city of Bombay. Right. Lal Pathlabs has bought that lab. So then they will have an agreement saying, okay, you can use the ABC lab brand name for 5 years. Right. So then in that 5 year period, slowly the value of that asset, that ABC brand name, right? ABC lab brand name will also have a value. They'll calculate that value. That value keeps going down. At the end of year 5, it will become 0. So that is called amortization. Okay. Then fees to some centers, channel partners. I think they are paying some fees. And then they have other expenses, which is 33. So we come to other expenses. What are all these other expenses for which they have spent 3,583 million rupees? So we see there is electricity and water charges, there is rents, there is some insurance, there is some repairs and maintenance, some advertisement, some traveling, some courier cost, some printing and stationery, legal charges, some payment to auditors, then some donations they have given to other than to political party, some corporate social responsibility related expenses, and so on and so forth. They have a lot of expenses here. So you can see, okay, what are the kind of other expenses that the company is now using? Then we have current tax and deferred tax. So we look at income tax, they're giving us companies subject to Indian Income Tax Act, companies assessed for tax payable determined for each fiscal year, beginning on 1 April, ending on 31st March, and so on and so forth. They are giving some details. And now they are giving some income taxes. Okay, in respect to the present year, how much have we paid? In respect to prior years, so for previous years, is there any pending tax that they are paying, or is there any tax benefit or anything else? So there is deferred tax here. So here, in respect to current year, there is some deferred tax in respect to prior years. So mm, they are just explaining what are the kind of uh, taxes that they have paid. Okay, is there, so sometimes when companies make losses in the previous years, so let's say a company has made loss for 3 years and this year it is making profit, right? So it can offset the profit against the previous year's loss and say, okay, I'm not going to pay tax. So let's say, for example, right, company A, let's say company A in 2021, it made a loss of minus 50 crore, right? In 2022, it made a loss of again 50 crore. Right. In 2023, it made, let's say, a profit of 10 crore. Right. So then it has the option to say, okay, I've made losses during these years and I'm actually at a loss. So I will offset this profit against this loss, and I'm not going to pay the full amount of tax and so on. And there are detailed taxation rules, and I'm not an expert, or I don't have much deep idea in that, but I do know that there is a lot of deferred taxes that are paid. Right. So companies typically give a picture of what are the kind of taxes that they are paying this year, what they have paid what they are paying with respect to previous years, what benefits they are claiming, and so on. Okay. Then they are giving some more details. This is the profit before tax. This is the tax rate. So they are being taxed at 25.168%. And then this is the income tax expense. And then there are some expenses that are not deductible, and they are making some adjustments. And then they are saying, okay, this is the income tax that we have basically paid, right? So there are some details in terms of income tax. And then there are some profit related things, and then there is earnings per share. So typically we are in a very simplified way. If the company has earned, let's say, 50,000, we'll keep a big amount. Okay, let's say the company has earned 50 crores. Okay, and then let's say there are, say, 10,000 shares, right? 10,000 shares exist. So then per share, how much have they earned? Which is nothing but 0.005 crores. That is the earnings per share. So in the same way, they are calculating earnings per share, but in reality, it's actually much more complicated. They will they have certain things that they can do, diluting shares and certain other things. We'll not get into the details of that. So for example, they can, like the owners have some options to convert certain bonds into shares. There are such convertible instruments, and there are a lot of financial gimmicks that happen here. We'll not get into that. But at a very simplistic level, if there are a certain number of shares, the net total number of shares usually doesn't change by much. And the earnings per share also generally, we can just say, okay, this is the total earnings, this is roughly the number of shares, and this is the earnings per share. We need not get into the details of all this because this is more from an accountant's perspective. Okay. So this is like a very high level of what we look at in terms of the statement of profit and loss. Right. Now, one of the key things that we need to look at in any statement of profit and loss is what is the profitability of the company. Right. So let's say, what is the profit margin? Profit margin basically means, let's say there is company, let's take two companies, right? Let's take two companies. One is Hatsun Agro. Okay. And let's take the other company, which is nothing but our Lal PathLab. right? So one company, Lal PathLab over here, you can see this is the revenue from operation. So we will consider this and this is the profit. So let's just say based on the revenue from operation, Lal PathLabs made a profit of say 3843 by 19667, which is approximately 19%. So for every 100 rupees of revenue that they earn, they are making approximately 19.5 rupees of profit as an approximate. Similarly, if we look at Hatsun Agro, right? Let's just look at Hatsun Agro. So Hatsun Agro has 267. Hatsun Agro is a milk. Largely it gives you milk related products, milk, ice cream, and so on. So it has 267 crore profit for 7990 sale. So let's look at this. 267 by 7990 into 100. This is nothing but 3%. So for every 100 rupees of sales that Hatsun Agro is making, it is making 3% of profit, right? 3 rupees of profit. So let's look at sales and then profit, right? Hatsun Agro and then Lal PathLabs. Okay. For every 100 rupee of sales, right? For every 100 rupee of sales, the profit that it is making is 19.5 rupees, right? So it's percentage, sorry. So Hatsun Agro is making approximately 3 rupees. And for every 100 rupee in sales, Lal PathLab is making approximately 19 rupees. So what does this tell us? This tells us, let's say that tomorrow Hatsun Agro had they took some extra loan for some facility, right? And then they have to pay a higher interest. Then what happens? This loan interest payment, we see that over here in the income statement, finance cost comes over here, right? This is one of the cost. So Hatsun Agro will have some extra finance cost and their profitability will go down very quickly. From 3%, it can go to 2%, 1%, 0% very quickly. Whereas if Lal PathLab, for example, right, if they take a similar loan and if their profitability goes down, from 19, it will go to 18, 17, 16, 15, 12, 10, but they still have a lot of runway, right? So if there is some negative thing that happens in this business in Hatsun Agro, the company might quickly become loss-making. Whereas if we look at a company like Lal PathLab, even if something negative happens in the business, the company will not quickly, the company has a buffer. The company has a buffer due to high profitability. It will not become loss-making, right? So typically, whenever we look at the businesses, we should look at businesses that have good amount of profit margin, right? It is preferable to own a business which has a good profit margin as compared to a business that does not. It doesn't mean that this business is will not give a good share price return. No, Hatsun Agro has given a very good share price return. If we look at it over 10 years, you see Hatsun Agro has given good returns. It was 155, now it is 1,150, almost 10 times, right? But if something negative happens, they've run the business very well, they're controlling the business very well. But by chance, if something negative happens, this company can quickly become loss-making. And therefore, the share price may go down or something negative may happen. But whereas Lal PathLab, if we look at the Lal PathLab share, it doesn't exist for 10 years. It only exists for some 7, 8 years. If something negative happens to Lal PathLab, the company will not go into losses so quickly. So generally, we should be more comfortable with a company which has a higher profit margin, right? So let's look at this company called Tarsons. Tarsons makes for Lal PathLab, Tarson will manufacture all the equipment, the glassware, the plastic equipment and other equipment that are needed for the lab tests, right? So let's look at this company. This company had, okay, over here, it had sales of 229 crore and expense of 125 crore, which means operating profit is 103 crore. Operating profit margin is very high, 45%, right? Operating margin is 50%. Whereas the same thing, if we look at Hatsun Agro, the operating margin is typically say 10%. It can go as low as 9% and it can go as high as 13%, but typically it is 9, 10 or 11%, right? So it means that when Tarsun's product, if something negative happens in Tarsun's product, and something negative has happened in Tarsun's product over the last couple of years, which is why you see from March 22 to March 24, there's not been much sales growth. The operating profit margin has gone down, but company is not at any risk right now. Share price may be a little down, but company is not at risk of sinking and you are not at risk of losing your money, right? So that is why if a company has a higher profit margin, that is actually a good thing for us in terms of investment, right? So today we learned three criteria in terms of investment. One is increasing sales growth, increasing profit growth, okay, and high profit margins. Because our aim is one, when we look at investing, our aim is one, don't lose our capital. So if you invest, let's say 10 lakhs into the stock market, and if some company crashes and you lose your money, then it's gone. So the first rule of investing is don't lose your money. And the second thing is to get good returns, right? So as far as don't lose capital is concerned, choosing a company with high profit margin will help us with this. Okay. And then as far as get good returns are concerned, if we look at a company that typically has good say increasing sales growth and increasing profit growth, of course, we have to study the market and then understand whether profit will increase in future or not, sales will increase in future or not. But this is one way in which we can get good returns on our share price. Okay, so this will be some of the key criteria we will look at. There'll be many other criteria that we'll be adding to this as time goes on, but this is something we have to keep in mind. So now let's do one last thing. Let's compare, let's see how to read screener versus how to see this in the actual income statement. So we see here, so we saw here, we are actually looking at standalone statement of profit and loss. We are not looking at consolidated. So we have to come here to standalone. Okay. Now we are looking at year ended March 2024. So we look at March 2024, and here you can see revenue from operations is 19,667 million rupee, and screener has shown this as 1967 crores. Right. Now we are having some other income, but that is not part of the normal income. So screener has not considered this over here. You see here, other income is over here, 60. Right. And our other income here is 600 million, which is 60 crore. Okay. And then we have the expenses. Now let's look at the expenses. So expenses we have over here, they have not given a number, but they have said employee cost is 18.49%. That's what screener is saying, right? So let's actually calculate and see. So we have employee benefit expense here. This is nothing but 3635.89. And we have to, and they are looking at this percentage, sales of this 1967. So we have to look at this one, revenue from core operations, right? Divided by 19,667.58 and then into 100. That will give us the percentage. So this is 18.486%, which if we round it off to two numbers, it will come to 18.49%. So what does it say over here? You see over here, it says 18.49%. So in the same way, we have, what else do we have? Simple thing, material cost. Let's look at material cost, for example, right? This is cost of material consumed. So we see here we have 3907 by 19,667 into 100. This is 19.86%. You see here it is the same. 19.8657, which will become 19.87 when we round it off, right? So in the same way, so here some manufacturing cost, we are not sure how they have taken it. We don't have a direct manufacturing cost here. So they have combined some different things here and taken it. But in general, we see when we are comparing the statement, right, to this, the statement we see in the annual report, we see that more or less this is the key things are matching. So then we see depreciation over here is 77. How much is the depreciation? See 765.39. So it is 76.5, which they have basically they have rounded it off to 77. Similarly, profit before tax is 5159. And over here they are saying 516. So 5159 million rupees is nothing but 515.9 crore rupees. We are converting million to crore, which is nothing but 516. And similarly, the profit comprehensive income 3840.96. And then we see here it is 3840 million is 384 crore rupees. So basically 10 million equals 1 crore. 1 crore is 10 million, right? So this way we can see that, okay, whatever we have given, whatever is given in our annual report, the same numbers have come over here. But the structure is a little different. Over here in our annual report, they have said this is the revenue from operation, this is the other income, and then this is the total. But over here, we find revenue from operation is over here, but other income is over here. So Screener is basically giving a more structured approach in terms of the other income so that across businesses, you see Screener will always follow this, right? The sales in the core business is the core business. Now, share price or bank interest or other things that they have earned in the other income, they may or may not earn it tomorrow. So Screener is focusing more on the earnings from the core business. Okay. So I think with this, will conclude today's class. We've more or less completed how to look at the basics of how to look at an income statement from any annual report. We have seen what are the notes and we've compared it to Screener, and then we have seen some of the key parameters we should look at, right? We have to look at increasing sales growth, increasing profit growth, and some high profit margins. So any questions in what we've covered today?
Harish?
Yeah.
There are two questions. First is like, say a country, a company which invests in, say, some manufacturing, in setting up a manufacturing entity, a unit, factory or something, then it will have two implications. Like there be depreciation, and probably it may borrow some money, and it might have interest costs. So how does so for that particular year, it might lead to lower profits than what is the normal trend. So how does the market does the market appreciate the fact that the low profits are on account of these investments which are likely to generate income in the future, or does the stock price go down? And the second thing is
So for the first one, the answer is typically the stock price goes down. So if we look at hospitals, right? So there are hospitals. Let's look at some hospitals where there are hospitals that are doing a lot of capex in India. So we have to pick up some smaller hospital which is doing a lot of capex. See, capex, we look at capex over here. This one, capital work in progress, right? So whenever a hospital does a lot of capital work in progress and then that becomes operational, that let's say it's built a new hospital, right? There is a hospital chain which has 100 hospitals, and then they have built they are building 5 new hospitals, and those 5 hospitals have become operational. Now, those 5 hospitals, typically a hospital will take at least a few years before that new, unit that they have built becomes profitable. Like people start visiting it, and then they start staffing officers. And it takes a few years. Let's say Apollo builds a new hospital near our near our location. It will take maybe 3 to 5 years for that new hospital to actually become profitable. That individual hospital. I'm not talking of Apollo Enterprises as a whole. I'm just talking about that one hospital. But during those 3 years, right, they would have taken some loan, and therefore they will have to pay interest. And then because this hospital has become operational, there will be some depreciation charges for the building, the equipment, and so on. So typically the depreciation, typically the profitability goes down, right? There are several cases when the profitability goes down, the share price actually will go down. There are a lot of cases where that happens. But if we dig into the business, right? If we dig into the business and if we understand that, okay, this profitability has gone down because they have opened, say, 10 new hospitals, and we'll typically find out those details in the con call transcripts, right? Con call transcripts notes, they will typically tell us 10 new hospitals have gone operational, and then we are building another 5 new hospitals. All those details, we'll find it in this notes, we will find it in the annual report, we'll find it in the quarterly statement and so on, but typically in the transcript when they ask the questions. So if we find those sort of things, that is a good opportunity to look at entering into the stock. That is the answer. Does that answer question 1?
Yeah. Okay, got it. And the second question is like, you're using Screener. So that feature where you created screens by entering some parameters, isn't a free, a feature
It's a
available
free
with a
feature.
free Screener? Okay.
All the tools that I've used are free. So in Screener, typically we come here, you come here, you see I've created several screens of my own, some 10, 12 screens of my own. We come here to new screener, and then you can give the parameters. So for example, debt, right? How much debt the company should have, low debt. You can look at the profit. You can define what is profit growth, what is the profit after tax. You can define all different parameters. So we'll cover this maybe in some other class in terms of how you look at screens. But let's just take one screen for example, right? I'm saying here profit growth for 5 years is more than 10% a year. Sales growth of 5 years is more than 5% a year, right? Similarly, I've defined profit growth for 3 years and sales growth for 3 years and so on, and then profit growth this year. So I'm basically looking at a stock which is basically generally profitable, right? Over 5 years and over 3 years, it's profitable. This year, it's not so profitable, right? Return on equity and all the financial parameters we will look at later. And then it has low debt, right? It has low debt. And then the current price is lesser than the moving average. So if we remember, we went to TradingView, and then one of the things we had seen in TradingView was that the price, there were different moving averages, right? Simple moving average of 5 years, of 10 days, 20 days, and so on. So if the current price is less than the 200-day moving average, or the current price is less than the high price all time by 1.5. So stock has come down by approximately 35%. Stock is below its moving average. So this way we can set up parameters. We can say, okay, the financial performance is good, right? All these return on capital employed, these are all financial metrics. We'll just deal with that later. Financial metrics are good. There is very low debt, and the price is low. So when we give these sort of screeners, we get this sort of a short list. And from these shortlists, we can start studying, okay, what is this business? What is this business? What is Happiest Minds? We can start studying those business. What is Carousel? So these are all some good companies. Carousel, Dreamfolks, Tanla Platforms. These are all some good companies that we can look at. And then we can take a decision on whether to invest. So there are several screens like this, and these screens give us a lot of, a good idea of which are the stocks we can potentially enter into. Oh, sorry, my screen was not shared. Was it shared? No.
No, but I couldn't understand.
Yeah, so typically there are all these screens. I opened one of these screens, right? And then there are parameters are here. This is the profit growth. This is the sales growth. And, these numbers are positive. The financial metrics, we'll talk about these later, what is return on equity and so on. They are all decent. There are some metrics we define as to what it is decent. Debt is very low. Company doesn't have debt. We should not take companies which have high debt, because a lot of companies crash when they are not able to repay their debt. They have so much of interest payment, they have low profit, and then it's gone. So their debt is low and the price is down, right? Price is less. Price is less than high time price by 1.5. So this price has to be 30, 33, 35% down. Then these companies come into our shortlist. And then out of these shortlisted companies, we can then start looking at, okay, what are the kind of companies that are here and what are the companies I like, and do I want to invest in that? Do I not? So in this way, using screens is one of the biggest ways in which I basically shortlist and look at which companies to invest into.
Okay, Harish.
So screener screens are free. There are a lot of other screens also on the web that are free. I typically only use screener because we should settle on one tool that we are very comfortable with. If you find something else more useful, then you or more comfortable for you, then you can settle with that particular thing.
Okay.
Okay. Any other questions? Okay, then thanks all. So I think next week we may do a few exceptions to income statement. So banks and all have a slightly different structure. Insurance has a different structure. So what we have discussed is the standard income statement, but we'll not go in depth. We'll just understand the basics of that, and then we'll start going into some of the other statements. We have the balance sheet, cash flow statement, and all of that. And then we have to do the financial metrics, all the return on equity, return on capital employed, debt to equity, and so on. So that's what we'll continue over the subsequent weeks. Thanks all. Have a nice week ahead.
Thank you.
Thank you. You too.